Okay, can you hear me? What's your name? Jinson. Can you hear me? If you can hear me, please reply. You can hear me, right?
Yeah, I can hear you.
Yes.
Okay. Let's wait for others to join. I hope you guys can see my screen.
Yeah.
Okay, so I said we were going to be picking from short-term highs and short-term lows today. So there was this clean trade I caught using the short-term high, short-term lows concept. So I'm going to explain this before we go on today. So let's just wait for others to join me.
How are you? Alhaji Myke, how are you?
Yeah, I'm fine, thank you. I'm fine,
Yeah.
thank you. How are you? Hope you had a good day.
Yeah, thank God.
Okay, let's get started. The session is recorded. I assume everybody is going to see it when they come. So, okay, let's see. So we're picking up from here. This last trade I caught here was just basically liquidity, nothing special. There was this long I'm looking at here. It's just basic liquidity. This is the rule of what do I call it? The rule of three liquidity sweep I told you guys yesterday. Someone's mic is echoing. Please, if you don't mind, turn it off. Jinsung. Alright, so this was the rule of three liquidity sweep I told you guys yesterday. It usually starts by sweeping the liquidity on the higher time frame. So I think it swept one of the 4 hours time frame first. Then after that, you notice that there was this minor sweep here, and this was the third liquidity sweep. So I'm expecting this to ride up to this point before it's continue selling. But then we'll talk about that one more when we get into liquidity. But for now, let's revisit the short-term high and short-term lows that I was telling you guys about. So, sorry, let me adjust my mic. Okay, so look at this trade here. This is a perfect example. This was a continuation because obviously euro has been bearish for a while, so it's selling. So this is more or less a continuation setup. Please, if at any point I'm not audible enough, do well to tell me. Are we together? Are we together? I hope you heard me. Hello?
Yeah.
Okay, good. I said if at any point I'm not audible enough, please do well to tell me. Alright?
Good.
So let's get back to it.
All right.
Sorry, I'm coming. So this was a trade cut with short-term highs and short-term lows concept basically. The short-term low, remember I said rule number one, there must be a liquidity sweep. This was our liquidity sweep in this scenario. This is what we use as our liquidity sweep because I mean it's a liquidity sweep. Rule number two, price has to create a short-term low and come back to breach it. This was a short-term low. Price moved. It didn't come to take out this initial low first. It created this, retraced, and then came back to take this out. Now, when it's breaching it, it must contain an imbalance. This was the imbalance. I believe you can see it. This right here, between this candle and between this point here, was the imbalance. Right? Then we're going to take our trade off the body where price changed its mode of delivery. That is this point here. This was where we took our trade from. Started selling from there down. Just a simple continuation pattern. We targeted the targeted low basically. I believe I've told you guys that there are different levels. There are targeted and protected levels. Right, those are two major types of levels on the chart. In a in a bullish market, you expect that every high is going to be a targeted level and every low is going to be a protected level. You expect, but that is just um, plain semantics. I'm sorry, semantics. That's like when you look at your charts or textbook. Let me say textbook definition. That's what you expect to see in a book. but not what you expect to see when you look at the charts. Because I mean, they are liquidity sweeps, so you cannot see every level is going to be protected. But if someone is explaining to you, that is how it's explained. So in a bullish market, you expect that every high is targeted, every low is protected. In a bearish market, you expect that every low is targeted and every high is protected. But then we're still going to talk about that this evening. So I don't know. I hope you understand the concept of short-term high and short-term lows now. I hope you don't have any problem with it. Let me see as others join so I can let them have my access. Okay, still just the three of us. I hope you don't have any problem with short-term highs and lows again. Are we together? Can you guys hear me?
Yeah.
Okay, if you have any question concerning this, please ask me before we go further.
Question from the last class.
No. I just explained. I just gave you guys this is a trade I caught today using short-term high and short-term using short-term low concept basically. So I just
Okay, I just
explained it
sorry.
again. Ouch. I'm using headset, so your voice there's way it hits my ears. So it's quite
Okay,
loud.
sorry. I just joined, so um, I did not get the.
Alright, so let me just run through it again basically. Do you remember the basic rules to short-term highs and short-term lows? I gave three basic rules yesterday.
Okay,
Hmm?
first the sweep.
First the sweep,
First the sweep.
perfect. Perfect. This was the sweep
Then
over here. Calm down, calm down. Let's follow it one by one. This was the sweep
yes,
over here, right? This was the sweep. This is a
yes.
continuation model because it has been selling, so it's a continuation trade. So this was the sweep. What was the second rule?
The second rule is it must be breached by an imbalance.
No. It creates a short-term low, which means it doesn't come back to take out the initial low. It engineers its
Okay,
own
yes,
low. That is this point. It engineered this
yes,
low, retraces, and comes back to take it out. Right?
yes, with an
It came
imbalance.
back to take it out. Exactly. Now this is the imbalance present here. This is the imbalance here.
Okay,
Can
so
you
we
see
look
it?
for our entries at the end of imbalance. Yes, sir.
Then we'll look for our entry at the point where price changes delivery. That is this point here. Look at it.
Yes,
A
sir.
clean trade. I think this was a 4 hour trade. 4 hour trade, yeah. That it just sold it down. So this was just a clean this was basically short I'm using the short term low as like the basic explanation I gave you guys yesterday.
Yes,
Are we
sir.
together? And like I said, something that plays out on Euro USD 5 minutes time frame. Look at it. This is the 5 minutes time frame of Euro USD. I see it a lot on Euro USD. And I think if you should check UK oil too, you're going to see it on UK oil, if I'm not mistaken. Then there are some other pairs like that. It used to play out a lot on GBP before, but I don't really know. I think it's more or less the evolution of the market that is making it quite scarce these days. Right, so during this bootcamp here, there's something I also try to expose to you guys. Technical analysis is technical analysis, but regardless of the fact that I know technical analysis, there is something called pattern recognition. Every pair has its own unique patterns. There are some pairs that you see that would drop as high as coming to this point to trigger your trade. Look at it. This, if you were to go by last green candle before the break as your other block, this would have never triggered you in. This would have never triggered you in. So there are some pairs that would go as far as that to trigger your trade, and there are some other pairs that are just going to stop somewhere along the line before they continue. So that is basically pattern recognition. It's something I would also try to expose you guys to during this bootcamp. Are we together?
Yes, sir.
I hope I'm making any sense.
Yes, sir.
Hope I'm making sense.
So you mentioned two
So
pairs it played out. Excuse.
so
So you
so yeah,
mentioned you mentioned two pairs it plays out on often. One is Euro USD. What's the second one, please?
yeah. The second one I think is UK oil. I think I've seen it a couple of times on UK oil. I think I've
No,
seen it a couple of times on
that's
UK
stock.
oil. Yeah.
That's stock.
Sorry?
That's stock
No. It's
market.
an FX pair. No. It's not stock market. Search it on
Oh,
your trading view. You should be able to see it. Let me see if I can find UK oil. Look at it now. It's commodity crude oil basically. See, yeah, you can trade it on your forex.
I never knew about that.
Okay, so that is that for short-term highs and short-term lows. You guys should just backtest this one. Any issue or any challenge you encounter, you can come back and ask questions and I will use answer, right? So for the next step, for the next thing we're going to be looking at today is going to be protected and targeted levels. Right? So I'm coming, let me just switch to GBP USD. Let's switch to GBP. Yeah, this trade pissed me off. And this was where I wrote down the whole this thing yesterday. So that's why I'm coming back here. This was where I wrote it down yesterday. Okay, so I believe that now we can clear out this first two. Let's take these two out. Because we are done with them now. So just take this away. Now, the next thing we're going to be touching is going to be this targeted and protected highs and lows. So, okay, no, before that, let's visit liquidity. We'll visit liquidity before we visit targeted and protected highs and lows. So, on your chart here, or off the top of my head, if someone asks me what is liquidity, I'm just going to reply you with money because liquidity is money. Let's see if others have just so I can cancel my access. It's still just the three of us, the four of us rather. So on the top of my head, you ask me what is liquidity, and I'm going to tell you liquidity is money. It's as easy as that. Because on your chart, liquidity exists at every level where traders are going to put their buys orders, traders are going to put their sell orders, traders are going to put their stop losses, traders are going to put their take profits. Those are the major levels where liquidity lies. Because oftentimes you'll notice that sometimes you'll be on a trade and price will just stop you out before moving to your take profit. It is because price is seeking out liquidity. Right? There's no enough liquidity in the market at that point to push price to the next level. So it ends up taking out liquidity at a specific level to enable you to move to the next. I don't know if that makes any sense. So I don't know if you've ever observed seen a market like this before. Let me use this. I've seen something like this before. I believe most of us have. You see price will be doing like this, doing like this, doing like this, and then suddenly it does this, and then this. I believe we've all seen something like this before. Am I right? Can you guys hear me? Can you guys still hear me on my?
Yes, you can hear.
I believe we've all
Should I
seen
leave my
something like this
mic
on our
on
chat.
so that I'll be responding?
Sorry? Huh?
I leave my mic on so I can be responding.
No, you can turn it on when you want to respond actually,
Okay, okay.
but or rather it's off here. But I believe most of us have seen stuff like this on our charts before. Now, this is a classic example of price seeking out liquidity because this was a choppy market. No enough liquidity for price to take out this low. It just kept on consolidating and consolidating until it took out the liquidity existing here. Price couldn't move to take out this low. And that is the basic idea behind liquidity. Liquidity rests anywhere traders have their money set. Right? Now, take this for example. Okay, there's something my mentor told me when I was learning how to trade. He told me that trading is basically you're leveraging on people's emotions because all these candles they contain emotions. Yeah, as you're saying, the move to the upside. There are people that are expecting it to come down. There are people that want it to come down, right? Or there are people that are already buying. There are people that are already selling. These people are moving their stop losses and their take profits as price goes on, as price moves. Yeah. So look at this for example now. When we draw our trend line, we can see something like this. This was schematic I drew yesterday. Okay. So draw a trend line, we see something like this. We see a trend. There's an obvious trend here, which means that if I as a person opened what my started buying here from this point. Okay, no, I started let's say I started buying from this point. We saw price come, take out this place and come and bounce here. It's simple right to take this out. As a person now, I'm not going to leave my stop loss here because I don't want to lose on this trade. I'll most likely move my stop loss to this point or to this point. Just since we've noticed it's going on a trend, it means it will most likely bounce again from this trend line. And we're still expecting it to come back and still bounce again on the trend line to continue going upward. True or yes? True or yes? Now this isn't tech analysis, this is logic. Are we together? Can you guys hear me?
Yes.
So now this isn't tech analysis, this is more of logic, right? We are expecting it that after doing that, you just where is that my son? So we're expecting that we're expecting something like this again. Comes down and drops, goes back up again. This is what we're going to be expecting. Like if it was in let's say if it was as it is in the textbooks, this is what we're going to be expecting. So now you that got in here, move your stop loss from this point to this point. It returns, it bounces, it goes up, you move your stop loss now from this point to this point. It returns, it bounces, it goes up, you move your stop loss to this point. You notice that you are moving your money upward. And that is how almost every other trader is doing. A lot of traders are doing the same thing with you. And that is why you see liquidity always lies under a trend line. That's why there's always liquidity existing under a trend line. Are you together? Now, because of the fact that you moved your stop loss from this point to this point, which means a lot of other traders still have their trades here now, have their stop losses here now. It means liquidity also lies below this level. And that is why they'll tell you there is liquidity existing at every single high and every single low in the market. Because there are traders who have their stop losses set there. I moved my stop loss. I just got into the trade. My stop loss would be here. Someone that got in here would have that's trading in stop loss would have probably moved it somewhere here or here because he doesn't want price to come back and probably retrace back to his SL and leave him after seeing profit a lot of profits, you just end up in loss. So that thing has a way of messing with your mind. So you have your stop loss here now. And that is why every single high and every single low there is liquidity. So basically, I've called two places now where there are liquidities. Every high and every low, and along a trend line. Am I right? Are you guys following me? Are you guys following me?
Yes, sir. Yes, sir.
Right now, for the third place, third area of liquidity, the third area of liquidity is going to be every area of the test. All those ones are things that we already know, Sha. I'm sure that whoever taught thing analysis would have already explained this to you before. All these ones are just like basic of the basic. We'll soon get into the serious parts. Just give me a minute. So every single area of the test had this. So now this is a double top. It is obvious that you expect liquidity to exist here. Price can come and sweep this and drop down. It is obvious liquidity has to exist here because it's an area of the test. I don't know, someone's mic is echoing because it's an area of the test. Liquidity will exist there. Double tops, double bottoms, triple bottoms. There are always liquidity existing there. So all these ones now, I call them examples of static liquidity. These are static liquidity because they exist at a fixed point. But then there is another type of liquidity that doesn't really exist at a fixed point. I call this one dynamic liquidity. Right? Imagine your moving average. Right? Um, sorry, give me a moment. I think this is where I'll find this book. Imagine your moving average. Right? This is how your moving average looks. Am I right? This is how the moving average looks. Now, liquidity also exists on the moving averages, and most people don't know, but it exists whenever you see price taps into the moving average. You see price retest the moving average a couple of times. Let's say this happens, then this happens. Let's say it doesn't touch first, as well comes to test at this point here. Automatically, it has created liquidity existing below this moving average because indicator traders now are going to move their stop losses to this point here, this test. So now, automatically, price has created another liquidity under this moving average. That is from this point here. So you could see market doing something like this, coming down to just go below the moving average. It might not necessarily come up to this block. We just drop down below the moving average, probably pick up another block or something from here and continue going up. Are we together? Now this is what I call a dynamic liquidity because it isn't existing at a fixed point. It is something that is not static, it moves. Because the moving average moves. I usually prefer using the 200-day moving average if I'm checking for such things, but this is something you have to settle down and check. And most times you just use it as an added confluence. It isn't compulsory to use. Are we together? Can you guys hear me? I don't want only one person replying. I want to be sure everybody's following. Enoch, Jinsun, are we together?
Yes. Good.
Yes.
Okay, I hope this is making sense.
Yeah.
So for the next, so after I've explained liquidity like this, now I want to now use this to explain targeted and protected highs and lows. Right? So here is the simple trick. Here's a simple trick to it. To targeted and protected highs and lows. Yeah. On your chart here, whenever you see liquidity sweep at any level, any given level, right? Let's take from a low now. Um, Perfect. Let's use. Let me see if I can draw. If I can just draw the schematic for you guys. I forgot I wasn't using this tool again. Okay, so let's draw this schematic for you guys from here now. Let's break the structure, and let's see this comes now to take out the liquidity existing here. Right? Now, whenever you see this liquidity, we're assuming we're in a bullish market. Right? Once you see this liquidity, automatically this place where this liquidity swept has become a protected loan. We don't really expect price going below it again. Right? Now, this here becomes a targeted high automatically. Automatically. Now, well, let's say in this a bullish market, right? This is something happens like this. This is something like this happening. This is something like this happening in this same bullish market, and this is a liquidity sweep. Now, this level here becomes a targeted low, and this wouldn't become a protected high necessarily until after you've gotten confluences. But this becomes a targeted low. And do you know why it becomes a targeted low? Who can give me the reason? Can anyone give me the reason? Anyone who wrong answers, I'll tell you if you're wrong or you're right.
Is it because there's no imbalance?
No, that isn't it. Someone else should try.
Break and retest.
Sorry?
Break and retest.
Weak and retest.
No, I mean break.
Sorry, break and retest.
Yeah.
Kind of, yeah, somewhere along the line, but try to like um explain it some more. Have you guys ever heard of IP and EPA before? Hmm? Can you guys hear me? Can you guys hear me?
What about this?
All right, good. Now, this is because this is an inefficient price action. And it is an inefficient price action because of something I explained yesterday. I told you guys the general rule is that when price takes out a structure, it is expected to retrace back into 0.5 level of the structure that was taken out. True or false?
True.
Perfect. Now, this never went to 0.5 level. In fact, it retested from the 0% level here. This is the 0% level. This was the structure. It tested from 0% level instead of coming back in. And because of this, let's say we see a liquidity sweep here. This low automatically becomes a targeted level. This low right here automatically becomes a targeted level. And if you should get your confluences, you can trade and short it down to this low. And this low is also going to serve as inducement or whatever that you can use to get a long trade from somewhere around down here. Are we together? Are we together? Can you guys hear me? So basically here, in retrospect, an inefficient price action is a situation whereby after the break of the structure, right, price doesn't returns, like it doesn't retraces back to fill 0.5 level. Now that is where you notice that's when you start noticing all those large imbalances on the higher time frame. I believe you've heard people say price always comes back to feel its imbalances. And yes, that is it always happens in the market. No matter how long it's going to take, it will come back to these imbalances. So inefficient price actions are what causes all these imbalances. If we should look at if you see something like this on like the 5 minute time frame, the 10 minute time frame, go to the 1 hour time frame or the 4 hour time frame, you're going to see a very, very large imbalance system because it's an inefficient price delivery. It's an inefficient price delivery that has to come back and be filled. So basically, that is why this point becomes a targeted low, and this becomes a targeted low. That's the reason it becomes a targeted low. And if you get your good confirmations here, this level is going to be protected. But then I usually recommend that if you're trading a reversal, you for either a second break of structure, always look for either a second break of structure or a second liquidity sweep if you're going to be trading off short-term lows or short-term highs. I don't know if I'm making any sense. So yeah, that is for targeted highs and targeted lows. Wherever you see a liquidity sweep, anytime whenever price sweeps a liquidity, the closest level to it is always sorry, the closest after sweeping the liquidity, where liquidity was swept becomes a protected low. That is if it is along the trend. And the closest level becomes a targeted high. And vice versa. That is in the bearish market and the bullish market. Whatever. So I hope that makes sense.
With that again, the statement you made just now.
Once you see a liquidity sweep, let's say in a bullish market now, for example, you see this liquidity sweep to the downside, right? The closest high becomes a targeted high, and this low here, that is the lowest point after the liquidity has been swept, becomes protected. Becomes protected. Then, when you get an inefficient price delivery, that is something like this, remember you always have to wait for this liquidity sweep. Liquidity sweep is the most important thing. Now, if you're waiting for the liquidity sweep, you want to wait. If you are going to be trading against trend, you want to either wait for two break of structures, or if you're going to be using short-term highs or short-term lows, wait for two liquidity sweeps. That is the first one sweeps, and you see a second one. So I hope that makes sense. I hope that makes sense. So that is that for liquidity, targeted and protected highs and lows. Right? Are you together? End of June song. I hope you guys are following up to this point. It's like Enoch is no longer with us. Jameson, did you follow up to this point? Can you hear me?
Yes, we can.
Yes.
Okay, let's assume Jameson isn't with his phone soon. So I guess this is where we're going to be calling it a wrap for today. So tomorrow when we come, we're going to be considering from we're going to visit power of three candles. After power of three candles, we'll talk about premium and discount pricing before AMD. Now, after all those, I'm still going to do one more class with you guys before we start live trading sessions. I'm going to host one more class with you guys after we are done with everything on the scheme. I'll host it before we do start the live trading session. I'll host one more class with you guys, and that is just going to be the class will be basically how you put everything together. Right, it's going to be strictly on the charts. There will be no schematics, nothing. That is before we start our live trading sessions. So for now, what I want you guys to do, go back test everything we've spoken about today. Make sure it works for you. You could study it on every pair. And yeah, least I forget, let me add this to this here. I forget. I told you guys I'm going to talk about pattern recognition with you people. Pattern recognition. It is one thing to know technical analysis, it's another thing to recognize patterns. Not every pair follows the same patterns on the chart. You notice that some pairs will play out after a liquidity sweep, you break structure and boom, it is going. While some pairs you notice it plays around the beats, might come back, do a couple of other things before. So there's something that we call pattern recognition. So just as how we notice that short-term highs and short-term lows frequently plays on Euro USD, but GBP has a little glitch because I don't really know why it doesn't really give us the results we are looking for every time of GBP. It doesn't always print it out the way we expect it. So that is where pattern recognition comes in. You have to know how to pick trades on pairs that don't really show you the pattern you're looking for. So that is going to be our final class before we do the putting everything together. Um, the rest is just going to be live trading sessions. That is the remaining days of our bootcamp. So I hope this helps you. Take your time, backtest this, make sure you understand it. And if you have any question, you can always drop it in the group chat and I'm going to reply it once I see it. All right. So, but for now, is there any question here?
Here's my question, right? Now,
Yeah,
when
me
we
too.
are trading lower highs and lower lows, my question is how to recognize when it's going to be a reversal, when we are going to be using it to trade a reversal or a continuation.
We've not gotten to where you'd use it to do all those ones. Well, like I said, all those ones will come after we've spoken about premium and discount pricing, right?
Okay, okay, okay.
Because basically, you expect reversals from always. You expect price to sell off from a premium level, and you expect price sell off from a premium level, and you expect price to buy from a discount level. So when we get to that part, we're going to talk about how to recognize reversal trades. But just know that whenever you're trading along with the trend, let's say the market has been buying and you're just taking a trade that is buying, that is an established trend. Just know that whenever you're doing something like that, it is a continuation. Every single time it's a continuation. And when you're going to be taking reversals is when probably market has been buying and you feel, oh, it's overbought and it's time for it to reverse. Just like um, give me a moment. I want to get you an example, like the one I sent this evening to my channel on how do you call it, Euro USD. This one I sent this evening, Euro USD. Where is it? I think this should be it. Where it just come. Like this now is an example of a reversal. This is me catching a reversal trade here. This is me catching a reversal. All together, this is me catching a reversal. So yeah, I hope there is no other questions this evening. Any other questions? So I guess this is where we're going to call it a day. And I'll see you guys same time tomorrow. Right? Please, everybody should try to avail themselves. Okay. Good night.
Imagine.